Hi there, Sam Lee, President and CEO of Northisle Copper and Gold. We have a large copper and gold porphyry in British Columbia. We have a preliminary economic assessment with a $1.1 billion after-tax NPV, with 19% after-tax IRR, 22-year mine life, 100 million pounds of copper, 100,000 ounces of gold for those 22 years. We have a very interesting and aggressive exploration program that we are continuing to move forward over the course of the next 2024.
Sam, good to see you. I know you're there in Zurich, but I guess the mood must be buoyant. You know, gold at $23.65 and copper at $4.32. Tell us, what are the nature of the conversations there? What are you hearing?
Sure. Like obviously, this sustained momentum in the gold price. We started in and around end of February, early March. PDAC was kind of the grand unveiling of this new paradigm. There was, I would say, kind of mixed belief as to whether or not it was going to be sustainable, whether or not it was going to, keep at the highs of $2,200. Clearly, we're a month past that now. We think most people feel that we're now rebased to the new paradigm within, the 2,300 level. And so then the question is, what is the next base? And as you know, as we spoke about before, usually these rebasings happen in exponential form when you go on the upside and on the downside. So there's certainly talk around, what does a $3,000 price environment look like around this conference? I think that there's much more conviction clearly in the sustainability of the price levels today, which is leading to significantly more risk-on behavior, which we did not see during PDAC in March. So I think that's going to set the stage for a pretty interesting quarter.
Yeah, well, we should do. And we are going to talk about Northisle Copper and Gold in a second, but I want to kind of get your thoughts around why the gold market, and I guess more broadly some of the other metals too, are starting to rip now. We've had 3 years of sort of intransient behavior in the sense that it wasn't reacting to higher cost environment, it wasn't reacting to, depressed currencies and this printing of money. Why now?
Yeah, so I think I spoke to you about that, the copper situation in the last interview. I think the gold situation is slightly different, but more around the same broader concept of accumulating assets, hard assets, during what I would consider a wartime scenario. A wartime scenario is when you see allyships between friendly countries coming together. You see distrust in other countries. Obviously, that bodes poorly for fiat currencies. Fiat currencies have underperformed hard commodities over the last 3-4 decades, but recently it has underperformed even greater than its historical averages. And so we're seeing a lot of buying coming up from China. We're seeing a lot of central bank buying, which is stimulating the gold narrative. I think that the momentum trade, as we talked about last session, is taking part now. There is this, again, belief of stabilizing at these new base levels, which again is fueling greater intensity. I think you do see some generalist buying within the commodity itself, not necessarily the underlying equities. But I do, believe that this continued momentum off of what you would describe rightfully so as, a positive gold environment for the last couple of years has finally catalyzed and triggered its upward momentum.
Right. But what's it going to mean for equities now? Because again, we haven't seen any movement in equities, no matter what stage of company, what quality of company. No one's really seen any meaningful movement. When does this kind of cascading effects start to take effect, do you think? Because producers are going to be making significantly better margins with hopefully a cost base which doesn't change much off from where we are now. We've seen too much of that over the last couple of years. So talk to me about this kind of cascading effect from producers to developers through into exploration.
Yeah, so I think that you're absolutely right in suggesting that this cascading effect from top-down commodities, low risk, low gearing, to high risk, high gearing, that's the traditional movement that's always happened, right, in cycles, recent cycles. We're not seeing that today because at least at this conference, what we are seeing collectively, not just small junior companies, but also large cap companies, is again this risk on attitude, right? So the I guess the absence right now of generalists in the equity space, not the commodity space, but the equity space, has created a bit of a void in the senior producer space. And I think partly it's because of what you just said, which is that we've had hyperinflation over the last 2-3 years through disruptive events such as COVID, supply chain disruption, et cetera, et cetera. And we haven't seen that same movement in gold price on the revenue line, right? And typically what happens is gold price moves, and then there's usually contraction in margins because then costs come up to the levels of gold price. Now we're seeing almost an inverse of that, where you're seeing costs increasing to the point of excessiveness and a catch-up trade with gold. So what does that mean? Well, it means that the initial valuations get obviously impacted by contracting margins. We've seen senior gold companies over the last year underperforming the peer group, underperforming the index because of that contraction nature. We've had some, obviously bespoke operational problems and contraction as well, which also exacerbates the issue. But now I actually believe we're in that environment where, because clearly we can see where gold price, where the revenue line is going to be for the next couple of quarters. And unless you're hedged, which very few of these people are, they've learned their lessons from many mistakes in the past, you are going to see margin expansion, because I don't see the forecast suggesting that, cost inflation is going out of control as it did over the last couple of years. So over the next couple of quarters, I think it's reasonable to expect an expansion of margin. And given that the low valuation environment today of these seniors, I think you're going to see price increases, and that's going to attract the generalists. I do think, maybe perhaps correcting you, I think there is a trade that's going on right now in the junior space, which is, again, odd, because it is a little bit counterintuitive to the cascading effect. It's an inverse cascading effect. And of course, the junior space does not move like the senior space. Senior space is like an index. Everyone kind of moves up coincidentally together as a group. But the junior space is a stock pickers environment. And the sort of, certainly the feedback we're getting here in Zurich is that investors now want to find that 5 to 10 bagger before, these fundamental margin expansion motifs, which again is quite peculiar given the environment that we're in right now. But that's how it is today, this week. Perhaps it's a little bit of euphoria settling in around where gold price is. I'm really not sure. I think it's also this segment of population here is, again, X the generalists. We're just talking about, high net worth family offices, retail. So that segment of the population certainly is driving that. And of course, there's going to be in the junior space winners and losers. If the message here at this conference is you pick winners for the reason, they win for a reason. And the idea is not to sell these winners prematurely, because again, the fundamental basis for which they're winning is what's going to make them successful in the future and allow them to continue to win. So that's a pretty strong theme around the stock picking strategies that are kind of resonating within the discussions here.
Okay, talk to me about risk, and talk to me about risk in the context of recent history. 2020, we saw a lot of money flowing in. People lost their minds. Companies being invested in that perhaps now, with hindsight, we know perhaps should not have received that money. You've mentioned today hedging from producers, perhaps who, again, from recent history, some lessons learned. Developers now looking at different business models, looking at smaller, phased, staged entry levels into production, because CapEx has not been easy to get. Do you think that in this high gold price environment, and as you're indicating, perhaps bigger margins to be had, larger margins to be had, that recent history will be forgotten and people will go back to, it's the good times and revert back to, previous behavior? How do the different audiences from companies and investors behave?
That's a lot to unpack.
Well, just risk more broadly across the sector, I guess. Simple way of putting it.
The hedging obviously was a part of 2 decades ago when obviously Barrick notoriously hedged out all of their upside exposure, which at the exact wrong time, which is what kind of caused them to be quite exposed when gold prices shot up. We haven't seen any of that behavior, or at least not within meaningful companies today, because we all know that the gold investment, gold equity investment, is a capital gains investment. And despite the efforts over the last decade for gold companies to try to appeal to a little bit of a yield investor through dividends, we all know that it's the essential investment strategy for gold equities is capital gains investment. So that means you have to buy and sell at the right time, right? You can't buy something and keep it in your portfolio for 10 years and expect it to be something that is going to be like Coca-Cola, for example, right? So with that in mind, have the generalists learned the lessons from circa 2009 to 2011 and beyond? Well, that's soon to be told. I think that, if the mass amounts of money that the general investor pool has can certainly move mountains in our industry, and the effect they have certainly can move mountains with our industry. And if they believe that the investment proposition is based on margin expansion, well, that margin expansion usually does not happen for a very long time. It's usually a very concentrated period within a cycle when we do have disparities between costs and pricing. And as I said, I do believe we're in that period right now where margin expansion can exist, because there is that disparity where obviously costs have risen and margin contraction has occurred and devaluation has occurred. And now we're seeing the top line revenue, i.e. gold price, being at all-time highs and potentially creating that expansion over the next couple of quarters. But it doesn't last forever, as you say, right? And you really do have to watch the macroeconomic events, not only around pricing, around gold prices, but also around the things that affect costs. I think the other kind of movement shift we've seen over the last couple of years has been this emergence of longer life assets, right? So because gold has historically been such a capital gain investment, when you've got small companies that have 8-10 year mine lives and they stipulate IRRs of 30% plus, like that does not incorporate the reality of having to redeploy your capital every 5 years, because you have to continue to make that mine go for beyond 10 years, right? So, I think that is something that, quite frankly, the market has caught on to when smaller sort of gold mines say, oh, we have 30% IRR, 7-year mine life, 5-year mine life. Well, that's not a real IRR. You have to redeploy that capital in order to make that a 10, 15, 20-year mine life. And so the big guys have recognized that a while ago. So that's why they went for bigger projects, gold projects, but they're now even taking one step further than that. And they're looking at projects that are even more long dated, which is why we're seeing this, emergence of big copper porphyries coming into favor, because obviously gold is associated with copper typically sometimes in these copper porphyries, and these porphyries have life of mines of 30, 40, 50 years and beyond. So I truly think that in order to be sustainable in the financial sense, gold companies have recognized that long-dated assets are the way to go, and certainly porphyries allow you to have that ability to weather multiple cycles, as opposed to having to live and die by these very short periods of investment opportunity. So there's a lot of change that's happening in terms of risk profiles. I think the other risk profile we've talked about in the past certainly has to do with geopolitical risk, right? So, I keep on saying 30 years ago, BC was a pariah state for copper porphyries. 30 years ago, we were probably one of the leading copper producers, copper producing nations in the world. And then we were displaced by, Chile, Peru, Argentina, Africa, all these other countries started to emerge and become, dominant in copper production. And that's because you could accelerate projects quicker in these areas. You had obviously very prospective and geologically rich projects down there as well. But now, fast forward to today, you see the social license being impacted tremendously because of perhaps the same condition that existed 30 years ago in British Columbia, which is this emergence of not only environmental protection, but social license, consent agreements, First Nations, Aboriginal title, etc. So I maintain, and I've always said this, that, I believe that BC specifically is about 30 years ahead of the rest of the world, or at least these other producing jurisdictions, as it relates to these social conditions that effectively, in British Columbia provide assurance that once you do get your permits, you've got assurance that you're going to actually have a mine producing for that length of the duration of that permits. And so we're seeing, obviously, the big companies, Newcrest, Newmont, a number of Rio, all these big tech is obviously, this is where their home is. That's the reason around, I think, this diversification of risk within their portfolios, is that they're making sure that, not only are they spending a lot of time in, the geologically rich areas, but they're also considering the social and geopolitical risk associated with that.
Well, look, as a kind of quite conservative investor, I'm not seeking 5 or 10 baggers. I'm very, very happy with the double. That's fantastic, and I imagine there's a lot of institutional money that kind of feels the same way. But I've got to still be sure that my investment will be able to kind of move forward. So I appreciate what you say on the risk side of things. How do companies communicate that to current makers? The generalists haven't moved in, so you've got to talk to relatively sophisticated natural resource investors on the institutional side. You're going to have to set yourself up how. I mean, you're at that position now as a developer. So what are you doing? What do you need to say?
That's right. So as you said, the generalists, the majors, that trade is coming. I think, there's nothing that you need to say outside of showing good results and that actual margin expansion. That's inevitable in my opinion. As a junior, as I said, you do have to identify yourself as part of that winning group, and that winning group has to have a compelling strategic plan around how to balance the risk. And the way we've balanced the risk as a junior company is understanding and fully appreciating that exploration, that value through the drill bit is how you are going to get that 5 to 10 bagger. So understanding that, of course, it's not guaranteed, but without a thoughtful strategy around how you create growth within your portfolio is exceedingly important to appealing to these individuals, these, family offices, these high net worth, these retail investors who, interestingly enough, are, as I said, are becoming almost price setters now, as opposed to price takers, which is what historically they've been. You have to show them that growth is there, right? They're not going to take the risk without the presumption of growth. But I think where we really resonate is that we have the underlying fundamental value in place. We already have a $1.1 billion NPV, net present value, 8% after tax, an IRR, a very high IRR for a 22-year project of 19% after tax. That is our underpinning value. In indicated resources, we have almost 5 million ounces of gold and 3.5 billion pounds of copper. And, across our overall global asset suite, if the magic number is for a major base metal company, is 1 billion tons, that's kind of when they start waking up, and is the threshold, the basement threshold for size. Well, we're there, right? So if you can couple exploration behavior and potential growth, which I think over the last year we have really demonstrated the potential nature of across our 35-kilometer porphyry district, and we've been very methodical and judicious in allocating capital to the highest margin, highest value opportunities, highest impact opportunities today. But if you have that fundamental base, that basement, that's that cornerstone value proposition for which we have, then I think you're good. We're currently trading based on that NPV, which again, we're advancing another project with hopefully similar, if not better, economics. But if you just take that one preliminary economic assessment that we have published, we're currently trading at 0.1 times our net asset value, just based on that, without any of the exploration activities that we're doing, right? And that, to me, from a fundamental perspective for a PA, is tremendously undervalued. It's, I've always said this as an investment banker, we always, on a normalized basis, 0.2 to 0.4 is where a PEA project of this size, of this nature, should trade in this environment. We're nowhere near that. That doesn't include any of our other exploration endeavors that provide that growth. But it does provide confidence that, in any type of environment or any type of success we have as it relates to exploration, we still have that fundamental underpinning value.
Right. And time's money. I'm not referring to this conversation. I'm referring to your ability to, I guess, risk mitigate. You talked about, obviously, the permits and licenses and First Nations relationships, access to capital, the type of the cost of that capital initially, and the ability to kind of refinance at later dates. In terms of all of those things that you could have managed to ensure that you can insert yourself into this cycle, we're the beginning of hopefully a kind of copper reaction, a gold reaction to market conditions of the last 2-3 years. How do you, or should you, speed things up? How do you make sure that you're part of the first wave, as it were, or is that just something purely out of your control?
No, it's not purely. I think based on all the virtues I just spoke of, we have outperformed all of our peers. We have been the first ones out the door. We have been recognized as the leaders of the pack, which I think has always been our strategy. Obviously, we can't time the market, but quite frankly, we've been extremely active during this period of time where we have these tailwinds from a commodity perspective, which is also very helpful. But I think that, you still have to understand what the strategy and how that strategy then evolves as you go through every segment of the cycle. You talked about cost of capital, for instance, right? I think that cost of capital is an incredibly important thing. We're valuing our NPV, our project, at an 8% discount rate, which is a copper a cost of capital, if you will, sort of at least the globally accepted discount rate that analysts seem to use on a consensus basis. But if you think about gold and the cost of capital that you can get through gold, because it does trade as a currency, it's a critical currency, not a critical metal. The fact that you see these royalty companies trading at multiple premiums to their NAV, then they can actually give away capital at exceedingly low cost, 0 to 4%. I think our first interview, Matt, in 2021, we talked about this concept around the value and the power of gold being our base metal, right? But now it's becoming almost an equal part of our portfolio, copper and gold, which again gives us great power, great pricing power to advance a project that needs to be funded. So, from a funding perspective, I think we're in very good shape. I think I talked to you again, the first interview we talked about our concentrate. Like, our concentrate is extremely clean, very low arsenic, very low deleterious elements. It's got gold that reports into copper and rhenium, which is a critical metal in the U.S. It's a very strategic metal in the U.S. Our project could be one of the top 10 largest rhenium producers in the world. The lab reports into our moly concentrate. So these are extremely powerful virtues around projects that have to get developed sooner rather than later. I think I talked to you once right after marketing with our provincial government around the critical metal strategy, right? So what the government of Canada has done is they've identified 110 critical metal opportunities, copper of which being one of the most critical of those metals in Canada. And they selected 8 of us to come and market with them in New York in December of last year around the critical metal strategy. And the reason why we were asked as part of this group of 8 was because we have everything that the government is looking for. We have consent agreements with our First Nation groups. For anything we do prior to even going through the permitting process, we have to have consent from our First Nation groups. We have the infrastructure. This is a really important factor, right? in terms of your question around de-risking. The government has carved out $2 billion for infrastructure builds for critical metal projects, right? So these are roads, power, right? That's what the government's responsible. They're not responsible for mills and mine sites. $2 billion gets you nothing if you're looking to build infrastructure around the Ring of Fire or in the U-Power in the Yukon or wherever it's needed for critical metals, right? And they recognize that. And so that is why the focus is on projects like ours that have the infrastructure built because of a mine that existed there previously. BHP built out the entire north end of the island for a project of our size. So that's excess power. It's 100 megawatts of power, of excess capacity for the island. It means paved roads that go right into our projects. It means a port that's arguably the closest deep sea water port from continental America to Japan, which is where they sold their concentrates. That's only 25 kilometers away on roads, existing roads from our project. Port Hardy, that was effectively a 400-person town prior to BHP. It's now a 3,000-person town housing BHP's direct and indirect workers. So these are extremely important infrastructure pieces that allow the government to say this is a priority. So that's a big de-risking part of our story, and it allows the acceleration of our project above and beyond most, if not any project that's at our stage in British Columbia and Canada.
Well, I know you got to rush off, so I'm going to let you go. But one, appreciate your view on the macro. Kind of interesting because I think a lot of people talking about, well, it's all about the Fed. I think you're describing a sort of scenario perhaps as a little bit more complex and nuanced than that. I appreciate that, and obviously good to see that your project continues to move forward. Your good growth story there. But let us know when you get back. Let us know how you got on and any other kind of further thoughts. We'd be intrigued to sort of see how you got in terms of selling your company, your message, and how that went down, and obviously anything else you think we might benefit from. Appreciate your time today, Sam. Thanks.
You're welcome, Matt. Pleasure to be here.